Welcome to CEF Insights, your source for closed-end and interval fund education, brought to you by the Closed End Fund Association. You're listening to a replay from the Advisor Summit on closed-end and interval funds. This session on global infrastructure is moderated by Mike Taggart, Head of Closed-End Fund Investor Relations at Aberdeen, and features David Leggett, Lead Product Strategist and Head of Investor Relations at CBRE Investment Management.
Thank you, everyone, for joining our panel, Unlocking Durable Growth with Global Infrastructure. I'm your moderator, Mike Taggart. I'm the head of Closed-End Fund Investor Relations at Aberdeen Investments. I've been covering closed-end funds for over 15 years, starting at Morningstar, then at Nuveen, an RIA firm, and now at Aberdeen. I solely focus on our 15 U.S. closed-end funds and one Canadian fund. With me today is David Leggett. David, please take a minute to introduce yourself.
Sure, happy to do that, and it's great to be here. I'm David Leggett. I'm lead product strategist for CBRE Investment Management, specific focus in the listed real assets business within the company. Over 20 years with the firm. I serve as a client portfolio manager, but I'm also the head of investor relations for our closed-end funds, including the one we'll talk about today, the NYLI CBRE Global Infrastructure Megatrends Fund. The ticker symbol's MEGI.
Also known as MEGI.
MEGI, that's right.
So, David, given our audience, I'd like to start with, why people should invest in infrastructure assets.
Sure. I think, infrastructure plays two roles, right? On one hand, it's defensive. People need power. They need mobility and transportation. They need the digital connectivity, and that's regardless of the economic cycle. So, it's that durable demand, inelastic demand that makes the asset class, a defensive one. And on the other hand, it's also a growth story. And, we've designed our closed-end fund, MEGI, to really benefit from some of the most dynamic secular trends in the industry today. And what I'm talking about is digital transformation, the clean energy transition, increased electrification, AI power demand. Infrastructure is at the heart of all of these things mentioned, because they really can't happen without these physical systems that really form the backbone of our economy.
Right. And just so kind of we're all clear, infrastructure can mean different things to different people. So what do you mean when you talk about infrastructure?
So the way we at CBRE think about infrastructure is we think about it as, these core assets. So we go and buy companies that are the owners and operators of these assets that are, the essential services that we need to sort of, grow the economy every day. So at the sector level, I'm talking about utilities, transportation, midstream energy, and communications infrastructure. When you think about it at the asset level, what does that mean? Power plants, electric grids, toll roads, airports, rail systems, the pipelines, and also towers and data centers. And so there's a lot of different things if you think about the four food groups, but they share common characteristics, right? First off, they're essentially, those assets represent monopolies, right? So they don't face competition. They're capital intensive, and because they're essential, they've got that sort of durable and inelastic demand. And last but not least, each and every one of them have an effective way to pass through the impact of inflation to the users of those assets, so that cash flows themselves have positive inflation sensitivity. What they're not, Mike, which I think I want to point out is, when I talk about, for example, digital infrastructure, we're owning the towers themselves. We're not owning Verizon or T-Mobile, the carriers, right? So the physical assets. We're not owning an airline. We're owning the airport, right? So, I think that's an important distinction. And some of our competitors may include those types of companies in their portfolio. Again, we do not. It's those physical owners of the assets themselves.
Right. And so you have these capital intensive businesses, they provide essential services. That's the durable demand that you mentioned. And that's the defensive nature of the asset class that you mentioned at the beginning. And then we have these exciting growth prospects for the business as well, especially in a global portfolio such as MEGI. So over the long term, kind of looking back, how has infrastructure performed?
So if you go back 20, 25 years, global infrastructure's total return it's just over 7%. And and that's over a 25-year period. And that's in line with global equities as represented by the MSCI World Index. But it is a differentiated equity asset class, and its total return profile is differentiated. So it's going to give you equity-like returns long term with lower levels of standard deviation and higher levels of underlying income and income growth. A significant portion of the total return comes from income. So for long-term investors, what we typically see is they look at their allocation to broad equities to fund an allocation to infrastructure, because it's a ballast for the equity portion of your portfolio, providing lower standard deviation, like for like returns, and certainly downside protection, right? And so when there's market sell-offs, typically infrastructure, outperforms broad equities.
Right. So talking about market sell-offs. So, and you just mentioned like the long-term 20 some years. So ignoring the global financial crisis, the worst performing markets in the past couple decades were obviously initially during COVID and then during the 2022 interest rate tightening cycle. So how did listed infrastructure perform in those two more recent periods?
I think the big picture, those two periods were a challenging time for infrastructure. If you think about COVID, these user pay assets like toll roads and airports, demand evaporated overnight. Everyone was home, right? So it was just a challenging period for the cash flows, right? And then as we experienced supply chain disruptions, you had the government stimulus to sort of bring the economy out of the stagnation of COVID. We had that runaway inflation, right? That gave way to the historic interest rate tightening cycle, which is also challenging for, a capital intensive business like infrastructure. But, during the period of the interest rate tightening cycle, I'd like to say that it's not necessarily that, these are interest rate sensitive companies, but it's not that they can't perform in higher interest rate environments. I think they've proven that over the last year. The total returns are, 15% plus, very competitive. But it was simply because for the first time in over a decade, fixed income yields became more attractive. So what was a bond proxy of an equity, especially in the utility space, certainly was no longer attractive from an income standpoint. So, the rug of demand was really swept out from underneath this asset class. But what's unique about the time period, right, is that while you had sort of a derating of the multiple or underperformance of the asset class relative to broad equities, cash flows and fundamentals accelerated, right? And so we had all these secular demand trends that were still at play, right? Benefiting cash flows of these companies. So today we're forecasting, 8-9% cash flow growth for the underlying universe of companies we invest in. And that's significantly higher than the long-term average for the asset class. If you look back over the last 20 years, the average, annual earnings growth of infrastructure, 6%. We're calling for 8 to 9% going forward today. So you have, this very interesting setup of derating of the multiple, but acceleration of earnings and cash flows, which relative to broad equities today, even the nice run that we've had in performance over the past year, we're still very attractive from a PE multiple standpoint or a trading multiple standpoint, relative to broad equities. So we do believe it's a good time and a good entry point for the asset class.
Well, and you mentioned, the large share of long-term returns that come from income, and then, infrastructure investors seems like their cash flow and they like it to be predictable. One thing, we haven't really delved into, you touched on it, is inflation, right? So real assets such as infrastructure tend to be hedges against inflation. And I'm wondering, is there a disconnect between infrastructure's inherent inflation hedge and its cash flow orientation?
No, I think there's no disconnect. In fact, they're connected. And if you look across the different sectors, utilities, their regulated rates of returns, when those rate cases come up, they're able to, adjust those returns higher to compensate utilities for inflation or rising input costs or higher costs of capital. So it's a little bit of a lag, but there's an ability for utilities to, pass through the impacts of inflation, right, and increase their cash flows as that regulated rate of return goes higher. Another example and the most efficient is the toll road business or the towers business, where in the concession or the contract, you've got annual escalators of a fixed percentage or inflation. So, as inflation increases, they're able to capture that, and they're able to charge more per car on the toll road, for example, because it's automatically linked to inflation and reset on an annual basis. And because their operating costs don't rise nearly as fast, their cash flows are able to grow in real terms. And so it makes assets like toll roads, like towers, like utilities, a natural inflation hedge.
Hmm. So you mentioned it at the beginning. You have the infrastructure closed-end fund, MEGI. When you were creating it, why put that in a closed-end fund structure rather than an ETF or a mutual fund?
There's a couple of structural benefits, of a closed-end fund. It's a fixed pool of capital. So as a manager, we're not, having to deal with, redemption. So we're able to, hold these long-term assets and companies that own the long-term assets sort of over the long term and benefit through their rising cash flows, over time. And so that's helpful. We're able to, own preferred securities or convertible securities that, are not as liquid. We're also able to use leverage, right? And the goal for leverage and the way we lever the portfolio, it's leveraged about 25% today, sort of below our maximum allowed of 33 and a third. But we use a non-structural form of leverage. It's essentially a big bank line of credit. And so we're able to toggle it up and down based on, our view of the market. But we've kept it in place since the inception of the fund, because the goal of using leverage is to enhance not just the total return of the portfolio, but also the income profile of the portfolio. So as the NAV grows and we're active managers and we realize gains, the benefit is we're able to not just pass through the income received, but also feather in any realized gains into our distribution, right? And so the structure provides stability of the capital base. It allows us to get into some relatively illiquid securities. It's not a big part of the portfolio, but it's not something that you could easily put into a mutual fund. And we're able to utilize that leverage again with the goal of enhancing income and total returns.
And then, you talked about income earlier. We talked about how infrastructure investors like their income. So this seems like a good marriage. Closed-end funds, investors like income, infrastructure investors like income. You want to expand on that a little, please?
Oh, sure. I mean, income's the name of the game. And look, but we pay out 12 and a half cents a share on a monthly basis. So, that equates to a distribution rate for the fund that's around 10% today. It's currently covered by income, but as mentioned, it also can be covered by, realized capital gains. Our goal is really to deliver and pay out a distribution that's sustainable and covered by underlying income, also realized gains. There can be return of capital that comes through from time to time. As we think about setting and managing that distribution rate, of course, the income is coming through, but those realized gains that make up a portion of the distribution, it's not always going to be the case that it's a good time to sell. We don't have, again, the pressure from redemptions in that fixed capital base. So we may choose, not to realize gains at a point in the market cycle. And there could be some return of capital that comes through. But our goal is not to have a distribution that relies upon that. We're going to set it so over time, what was return of capital may be recharacterized as income or realized gains as things play out in the market cycle. The infrastructure asset class for a manager like us that's trying to set, a sustainable distribution that may rise over time, that 12 and a half cents, consistently every month. The predictability of the cash flows is a real advantage. When our companies report earnings, they report, utility is a classic example. They're giving guidance not just for the next quarter, but for the next 5 years. They'll just as a for example, they'll say, we expect to grow our earnings between 7 and 8%, not just for the next year, but for the next 3 or 5 years. So there's a tremendous amount of visibility into the cash flows and the income streams of these companies. And there you talk about a marriage. That's a real advantage for, an equity manager like us, an active manager that's thinking about, wanting to offer an attractive distribution rate to the market. The asset class is well suited for that.
And I just want to talk a little bit about the global nature of Meggie. There are a couple of closed-end funds that have a global kind of mandate when it comes to infrastructure investing, and Meggie's one of them. And I like to tell people, there's a big difference when we think of infrastructure. I think just in general in the US, when we think of infrastructure, right? It's when we go on road trips and we see all the highway construction, right? And it's the rebuilding of the infrastructure, right? And it's quite different when speaking about global infrastructure, non-US infrastructure. And can you talk a little bit about kind of the non-US exposure in Meggie, and kind of how you all think about that and that opportunity?
Yeah, and from a strategy standpoint, we favor developed markets over emerging markets. So just sort of big picture. And the reason for that is just transparency in government policy. You just don't have a level of comfort in the emerging economies about, the direction of policy, because policy risk is, one of the biggest things that we try to underwrite when we think about investing, not just here in the United States, but internationally. So we favor developed markets for that reason. One of the benefits of being global for infrastructure is that you can access a broader opportunity set. In the United States, it's a US only strategy. You would get utilities, midstream pipelines, and freight rail companies like Norfolk Southern or Union Pacific, and data centers, right? But the second largest sector in our universe outside of utilities is the transportation sector. And the US, again, it's just freight rail. But you've got to go international, and European-based companies, Asia Pacific, particularly Australian-based companies that own and operate toll roads and airports. That's actually been a very dynamic sector within infrastructure since the unwinding of COVID, because we've just seen this very slow resurgence of volumes in airports, in toll, traffic on the roads. And in fact, airport volumes today are higher than their pre-COVID levels. And so, that's been a very dynamic place to be, but you kind of want to take a global approach so you can get access to the full core infrastructure universe, and certainly things that you can't own that are available here in the US. And that's primarily those transportation companies.
Exactly. So now, I mean, we've kind of touched on it, so we don't really have to pivot talking about infrastructure today. But talk about a little bit, if you will, about government policy kind of in the U.S. What's happening in Washington that's supportive of infrastructure investment right now?
Yeah, you know, globally in developed markets, governments are pro-infrastructure, and certainly that's the case here at home in the U.S. And look, Democrats and Republicans certainly have different views, but at the end of the day, they're pro-infrastructure, because infrastructure and investment in infrastructure creates jobs and economic growth, right? So they can all kind of agree that that's an important objective, right? But they might share different views. And as Trump came into office, under Biden administration, the passing of the Inflation Reduction Act, there was a significant amount of tax credits and stimulus that came through that were supporting primarily the renewable energy industry, where we've seen some of that unwind on the the one big beautiful bill act, OBBA. But it still is supportive of the asset class. Just to make that clear, supportive of nuclear power, liquid natural gas, the modernization of the grid. There's some unprecedented clauses within that will support utilities, that is incentivizing them to harden and make their grid more secure. And while renewable energy tax credits are being phased out, it's still a really good business. There's a lot of headline risk there. And why, some of these companies will be able to benefit from, the tax credits as they're phased out over the next couple of years. There's still a tremendous amount of demand. Solar power delivered in the first 6 months of this year, delivered more capacity to our grid than any other source of power. The hyperscalers continue to want to power their data centers with renewable energy. And what we're seeing now, what we probably will likely see over time, is that the spot prices for wind and solar will continue to step up. It's sort of offsetting that negative impact of those tax credits going away in a couple of years for renewables. So what the Trump administration understands is that in order to be a leader in AI, we've got to be able to power these data centers. It's actually a topic of national security concerns, right? So it will be this all the above approach, right? We need diversified sources of power. We need it to be relatively inexpensive. We can't be dependent on one thing. And we need to bring on more and more power today to meet, demands for electricity.
And so let's keep talking about that, because it's more than
Yeah.
just AI and data centers, right?
Right.
And I mean, the demand for electricity is accelerating, first time in decades, like you said. I mean, it's all over the news, right? And
Right.
I mean, I think we all see it in our electricity bills. You mentioned data centers, but there's more than that that's driving that. It's more than the AI and data centers. Like you said, the utilities are a big component, especially in the US, for infrastructure. So it's an important topic, and it's an important driver of performance.
Yeah, certainly. I mean, just to put it in context, post World War II, the 50s to the 70s was a tremendous, period of growth in electricity demand in the United States, right? We've got, economic expansion. You also have sort of the electrification trends, people plugging in TVs for the first time, air conditioning, washing machines. So during that, several decades of electricity demand, we saw, electricity demand growth of about 5% a year, right? And then it really tailed off. And if you look through, the 90s and the 2000s, we had like 1% electricity demand growth year over year. So very stagnant, stable, just kind of growing along with sort of demographic growth and economic growth. So, but today, 2004, 3% electricity demand growth in the United States. So it was a spike in demand. There are utilities in our portfolio today in the jurisdictions that they service that are reporting 6-8% electricity demand growth year over year. So it is hockey sticking higher.
Right. So even higher than the 50s, 40s, and 50s that you mentioned earlier. So
it's getting to that point. It's going to, may it match that potentially, right? So it's getting back there. And to your point, Mike, it's not just about data centers. That's a big part of it. It's maybe a third of the stack, though, if you look at all the contributing factors. The other thing is, onshoring of U.S. manufacturing. Semiconductor, heavy industrials or semiconductor plants, they need a boatload of power, multiple gigawatts of power in order to make those manufacturing facilities grow. It's also just the electrification of everything. Just think about all the things that you plug in at home that you didn't even 3 years ago. All the different wires and connectors, but also, transportation, electrification of transportation. So the key point is it's not a one-legged stool. It's dynamic in the sense that it's a confluence of factors that really make this power demand theme sustainable and structural over the long term. And if you think about utilities, but also midstream energy companies like Williams and Company that just signed a contract with Meta, $1.6 billion contract, in fact, to develop and build these gas-powered turbines for data centers. You also have the digital, infrastructure companies like Equinix, that kind of are, there with those co-located, data centers with a ton of pricing power and a big CapEx spend plan to build out their footprint. And so that's about 2/3 of our portfolio today. You think about utilities, you think about data centers, but you also think about the midstream energy companies that were all positioned to benefit from this demand trend in one way or another. It's a big theme for us in the portfolio, and in a great way, again, to play a defensive asset class and get exposure to stable and growing cash flows that grow along with inflation, right? But also access growth at the same time.
yeah, excellent. Well, we still have about 4 minutes left. Are any closing thoughts for you, on infrastructure, or, on Meggy specifically?
Yeah, look, we've really covered a lot of really good ground, and I
Yeah,
appreciate
absolutely.
your great questions. And, I view the asset class as just really being at the beginning. We're like 1 year in our opinion, through like a 3 to 5 year run of attractive total returns. I mentioned the underperformance in COVID. We talked about the interest rate tightening cycle and how the asset class performed, or frankly underperformed. But that's the message is that's the setup we think for a nice run, long-term run for attractive returns.
Yeah, absolutely. I mean, and I think we see it in terms of when was it last year? BlackRock bought a big infrastructure firm, and I mean, we hear it more and more. Just infrastructure in general, not even about the electricity as component to it. So, I definitely think there are a lot of tailwinds to the infrastructure story globally, even not just in the U.S. So, it's definitely a good story and something to keep in mind, especially for advisors. And the kind of the underlying features that we mentioned at the beginning, right? The inflation hedge, the income component to it, all of that, the real asset benefits for a portfolio, they're real. So, and they can benefit a diversified portfolio. So, thank you so much for taking the time today to walk us through all that. I really appreciate the insights, and I'm sure our listeners did as well. So, thanks, David.
You're very welcome. Appreciate the Closed End Fund Association as well. Thank you, Mike.
Thanks.
Thank you for joining us for another episode of CEF Insights. Visit CEFA.com for more education from the Closed End Fund Association. This material is not and is not intended as investment advice, an indication of trading intent or holdings, or the prediction of investment performance. All fund-specific information is the latest publicly available information. All other information is current as of the date of this presentation. All opinions and forward-looking statements are subject to change at any time. Aberdeen and CBRE Investment Management disclaim any responsibility to update such views and/or information. This information is deemed to be from reliable sources. However, Aberdeen and CBRE Investment Management do not warrant its completeness or accuracy. This presentation is not intended to and does not constitute an offer or a solicitation to sell or a solicitation of an offer to buy any security, product, investment advice, or service, nor shall any security, product, investment advice, or service be offered or sold in any jurisdiction in which Aberdeen and CBRE Investment Management are not licensed to conduct business, and/or an offer, solicitation, purchase, or a sale would be unavailable or unlawful.